Yo, what's going on, people? Welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today I've got another Simply Wall Street journal for you. I'm talking about betting big and making sure that you find and identify the stocks that are positively contributing to your performance, and you evaluate them correctly so that you can decide whether to bet big on those and make sure that you can actually leverage the good performance that your stocks are currently giving to you. So before I get into that, I just want to say smash that like button if you're interested in that. Obviously hit that subscribe button if you're brand new to the channel. I'm on a mission to get to 2,500 subscribers, so any help that you guys can do to help me get there will be greatly appreciated. Before I get into the content of this video, I did a recent poll which I got 70 votes for, which is really cool, about what type of videos you guys would like to see more, and the options were investment strategy, stock reviews, personal finance, so banking, savings, credit cards, insurance, that type of thing, startups, or any other. Now, it was really interesting to see how the votes panned out over the last couple of days, but there is quite an overwhelming skew towards stock reviews and investment strategy. So I'm going to make sure that I commit to this promise and make sure that you will see a new playlist dedicated to investment strategy, and I'll give you my strategy for the way I'm going to approach certain situations, whether it's a recession, whether it's trying to make a certain amount of money, whether it's what I would do with £1,000, £100, £10,000, all that kind of goofy stuff. So hopefully you guys will like that. So look out for the new playlist coming, and I'll make sure that there's investment videos tailored towards that. I'll also make sure I increase the amount of stock reviews. So I did produce a video very recently on Bristol Myers Squibb, which is another stock to watch. This is the second of the stock to watch series, but I'll make sure that I increase the velocity of all of the stock to watch videos. So thank you for everyone that's been voting. Thank you for everyone that's given me a great insight into what you guys really want to see, and I'll make sure I do my bit to make sure that you guys have the right investment videos for you. But onto today's video, which is geared towards the investment strategy side of things. I wanted to talk to you about two factors that I think is really crucial when analyzing your portfolio. That's analyzing how much percent a specific stock makes up of your entire portfolio, but also what it means in terms of how much it contributes to your portfolio, and then starting to think about, you know what, is this a stock I should hold, I should buy, I should sell, etc. Before I get into that, it's been a good week. It's been a really good week. Started to get a bit more of a positive return. So as you can see, I'm at 4% return. The average in the market at the moment is 6.3%. So my main goal is to definitely beat the average and try to get into the 6.37% mark is probably where I'd like to achieve. So, you know, only being halfway through the year, I definitely think that is achievable, providing Trump account gets hacked and he stops tweeting. That's probably the best scenario for me having a greater performance, because it was decent until he started talking, until he started opening his mouth. So hopefully someone can take away his login details, and I can make some money. But today the contents of the video is primarily these two donuts I wanted to talk to you about in a bit more detail here. Donut number 2, which I'll start with, I wish it was kind of reordered. Yeah, I'll start with donut number 2, but I will flip to donut number 1. So donut number 2 is portfolio diversification, is diversification by company. And all this simply and very clearly indicates is telling you of your current portfolio, what percentage is dedicated to company X, company Y, company Z, etc. So this clearly tells you that 11.78% of my portfolio is in Aviva, whereas 7.11% of my portfolio is in Imperial Brands, where the 1.07% of my portfolio is in JP Emerging Markets Investment Trust, which makes sense because I only bought it a couple of days ago. So this is just a diversification in terms of where you've allocated your funds, which I think is a really important picture just to kind of see whether you're heavily skewed to some companies versus to other companies. This one, however, really is the cross section of that data. So rather than just looking at where you've invested your money, it then tells you of where you've invested, which one is contributing the most to your current portfolio. And it's really, really interesting to see some of the contrasting elements of that. So I'm just going to pick out a few of the negative aspects to my portfolio and some of the positive or indifferent aspects, and you guys can have a look for your own portfolios, and then I'm going to let you know what I'm going to do going forward based off that information. So first, the negative side. We look at things like here. You can see that Lloyds Banking Group, I have 7.36% of my portfolio currently in Lloyds. So a good strong 7% of my portfolio is sitting in Lloyds Banking Group. But when you actually try to look at what Lloyds is doing in terms of a return, what you can find is that Lloyds Banking Group is somewhere, here it is, 0.72%. So it's still giving me a return, but for me to allocate 7% of my funds, so that's 7% of what, 10,500 or whatever it is that I currently hold. So let's just say, let's just say for argument's sake about £800 or whatever, that is only returning me a profit of 0.72%. So again, that's a really, really clear picture that I've over-indexed probably into Lloyds. Although I do feel it's undervalued and it is good for the long term, maybe it means that I should hold more rather than continually to add on my dollar cost averaging and actually focus those funds somewhere else. But I'll get into that in a bit more. Another example is Taylor Wimpey. So Taylor Wimpey, we can see, is a whopping 10.55% of my portfolio. I understand why it's that high, because of their special dividend that they were paying at 6.84%, and I already held the stock throughout the course of the year. I definitely wanted to take advantage of that special dividend, and that special dividend is coming to me at some point this month, and it's going to be about £68. So I am happy that it has so much, just because I wanted that money. But at the same time, I do have to be cautious and look at, okay, for 10.55% of a holding in Taylor Wimpey, what is that currently doing in terms of my return? And what you can actually see here, I think it's one of these small little, wait there, where are you, Taylor Wimpey? I was actually going to ask you guys if you can see it, but clearly this is not live, so it's not going to help. It must be one of these. I can't even find it. No, it's not any of those. There it is, right next to Lloyd's. So that's given me a 1% return. So as you can see, I've spent 10% of my portfolio into Taylor Wimpey, not losing any money, but I'm only getting a 1% return currently as things stand. Now, I wasn't always getting a 1% return. There were times that I was getting a much more significant return, but obviously taking a dollar cost averaging approach, it does mean that I always bought at higher prices at some times and I bought at lower prices at other times, which has kind of averaged it down to this 1%. But again, that's a clear indication of me spending a lot of money, a lot of my allocation into one specific fund, however just getting a smaller amount in return. Now those are ones where they're currently in profit, but you'll find the reverse where they're actually not in profit. So look at it for example, Vodafone, I'm spending 6.61% of my portfolio into Vodafone, and as you can see, it's actually giving me a net loss of 2.05%. Now that's obviously going to happen. You are going to have scenarios where you're going to be losing money on a stock. No one's always going to be in the green, but again, it just shows whether you should overexpose or whether you should see that as a buying opportunity, which is what I'm going to communicate a bit later on in this video. Another example, as you can clearly see, is Imperial Brands is minus 11.41% in terms of the returns that it's giving to me, but I have put 7.11%, and as you guys know, I've been topping up Imperial Brands recently. I do plan to continue topping up, as I think and I'm hopeful that they're going to have a good earnings report, which will then put their stock back in good stead, and then I can decide what I'm going to do. In terms of a positive, or depends on when you look at it, this might be a positive or an indifferent way. Look at it in reverse. So First Solar, as a prime example, First Solar only accounts for 2.55% of my current holding at the moment. But what you can currently see is when you scroll up is that First Solar actually contributes to 15.44% of my return. So First Solar is only 2.55% of the money I put is in First Solar. However, it's contributing to 15.44%. So that is a significant opportunity where I'm not really maximizing the amount of value I could be getting from First Solar. I'm playing it maybe too modest, too cautious, and it's giving me the best return currently, and I'm only holding 2.55%. So, or two, yeah, 2.55%. So really and truly, I should be betting a bit more big with First Solar. Another example is Sentiment. As you can see, Sentiment is a 6.5%. So on average, I would expect 7% is probably the average, based on the amount of stocks that I hold. Now, 6.05% is just below average, so it's not that bad. But when you look at it, it's giving me a 15% return currently, Sentiment. Now, Sentiment is a bit of a sticky one just because it's a bit of a cyclical business. Because of what's been happening in the economy, gold is now being improved, and that's where Sentiment is having a better performance. Sentiment wasn't always my best stock. Sentiment often was one of my worst stocks, to be honest. And I've just held out because when I need something to hedge against, I can't have all of my money sitting in equities, because that means when the equities market goes down, then I'm effectively just going to lose. Now, obviously, Sentiment is a company, so it is still technically an equity, but it's an equity that's focused on gold mining, so it actually benefits from the gold commodity side of the stock market, as well as the balance sheet side or the fundamental side, providing it's run correctly. Another example, and these are the ones where it actually makes a bit of sense. Barrett, a good 6.41%, so an average amount of holding in Barrett, and as you can see, 11.15%. And another example is Aviva, 11% I hold in Aviva, and it's returning 9.5%, which I think is a good return for having 11%. So again, all this is basically illustrating to you is the volume, the amount I hold in terms of allocation in each particular stock, and then the amount that that stock is now returning to me by way of returns. Now, the question you then have to think is that, what does this mean? What do you do if a stock is, you hold a lot of it and it's only giving you a little bit in return, or you hold a little bit of it and it's giving you a lot in return? What is your next move? What is your next play? Now, I think you have to look at it from a number of angles. Angle number one is, if a stock is giving you a high amount of return and you hold a high amount of money into it versus your average, or what your average allocation should be, then for me, I would continue as is. I wouldn't start pummeling money into it. You already hold quite a lot of it in terms of the volume, and obviously it could have an adverse effect. It could take a switch. So in those scenarios, and the scenarios I'm talking about relative to my portfolio is the Legal and Generals, the Avivas, even potentially the Sentiments and the Barretts, I'm going to continue my normal dollar cost averaging approach. I'm not going to do anything different. I've been taking this approach for 7 months and clearly it's working. So I'm going to keep the same approach for these types of stocks here. Now, when you have a stock that actually you've got a lot of money in, such as the Taylor Wimpey's that I mentioned to you previously, or the Lloyd's, you've got a lot of money in. However, the return that is given to you, I mean, simply Wall Street don't even want to call out these names like in its own right. You have to hover over it. That's how bad the return is in that scenario. So again, you've put a lot of money into it, however you are making a profit, but it's a very, very, very modest profit compared to what you're putting into it. In that scenario, what I'm probably likely to do, and what I'm considering doing, is actually reducing the amount of money I hold into these stocks in order to put it somewhere else. So I'm not going to sell to go buy a car. I'm not going to sell to go buy some shrimp in Vapiano or whatever. I'm going to sell it in order to put it into another stock so that I could actually maximize that money and make use of that money a bit more better. So that's what I'm probably going to do in those two scenarios. From the negative side of things, or the positive, it depends on how you want to look at it. When you've got scenarios such as First Solar only being 2.55% of your portfolio but contributing to 15% of your return, I personally would then take a look at that company in isolation. So take a look at First Solar. Don't know if you can do it directly there, but I will go up here. I would take a look at First Solar, and I would understand the fundamentals of the company and just make sure that the fundamentals make sense. And should the company's fundamentals make sense, such as it's still being undervalued, such as it's got a good future performance that you guys can see, the ratios make sense, the balance sheets look good, then in that scenario, what I'm probably likely to do is the funds that I dial down from the sort of Taylor Wimpey's and the Lloyd, so to speak, I'm going to then reinvest in companies like First Solar. So obviously what that will mean is that the return percentage will fall just because I'm probably buying at a higher price because it's doing so well. However, over the long term, it will probably go back up into the right direction, providing it's a good stock, and I'll have more of my allocation in these funds. So again, this is not about, trying to save more money. This is not about trying to earn more money. This is not about trying to borrow any money to invest more. This is just all about rebalancing your portfolio and putting money in the right bucket so that it will actually work harder for you going forward in the long term. In the case of a company such as Centamin, where you can see clearly that Centamin is about 6% of my holdings, the average amount, and it's about 15.65%. In that scenario, I'll do nothing. I probably won't add any more just because I feel that Centamin is very cyclical, and right now I'm buying at a higher time, and so I wouldn't want to do anything in that scenario. Whereas you've got something like Imperial Brands, which is 11.41% negative in terms of the portfolio, and it's still 7.11%. So again, I would look at the fundamentals, look at what's going on with that specific business. So in the case of Imperial Brands, they've got an earnings update coming up in the 25th of July this month, which I'm hoping that the earnings will be a better report than what it was last quarter, which was the reason that the stock decided to start taking a dip. And if so, then that means I can obviously add more investments. Because I'm anticipating a better performance, I might try and add before the earnings update so I can actually be very, very early when investors take wind and actually start spiking up in that sense. That's probably the way I would treat that. You've also got things like, for example, I think I saw it here, Facebook, I'm only holding 1.5% of my allocation in Facebook, but you can see in the returns it's 8.65%. Now Facebook still is a growth stock, so I would expect Facebook to continue growing, and what you can actually see when you actually dig deeper into the Facebook fundamentals is that it does look like it's an undervalued company. It does look like it's a company that still has some growth within it, and we all know what Facebook is currently doing at the moment with Libra and the cryptocurrency and so forth. They've got a very healthy balance sheet. Obviously they don't pay a dividend, but in terms of capital gain appreciation, you could probably expect quite a lot from Facebook. So in that scenario, where I'm sort of dialing down some of the money I mentioned in the previous stocks, I will try and offset it and put it in again in those stocks. So this is just something that I think you guys will find useful. Definitely have a look at your portfolio and try and understand what is the percentage of holdings you have in specific stocks, and then what does those specific stocks mean in terms of a contributing factor to your capital gains, whether positive, indifferent or negative, and then based off the information I just gave to you today, have a think about what that means for your next steps. Do you hold, like in the case of some of these scenarios? Do you withdraw and actually put some more into some other stocks that are doing incredibly well for the time being, or do you what do you do? What do you do in that scenario? I hope you guys found this video useful. Again, the whole point of Simply Wall Street Journal is just to kind of take apart a specific aspect of the portfolio and sort of think about investment strategy and what you guys will do going forward. So if you did like that, smash a like on the video, please hit that subscribe button, please help the channel get to 2,500 subscribers, and I will be back next time with another investment video. I will have a lot more stock reviews coming up, and I will have a lot more investment strategy videos coming up in the next days, weeks and months. So please like, please comment, please subscribe, please share, and I will catch you next time. Happy investing. Take care. Have a great weekend, guys.